So what exactly are these standard multiples that brokers talk about when you go to buy a business? Hey there everyone, it's Dave Barnett from davidcbarnett.com, the blog site where I talk about buying and selling businesses, local investing, and personal finance. This week I have another question from a viewer about standard multiples when buying a business. If you want to learn how to buy a business from start to finish, you should be checking out my Business Buyer Advantage program at businessbuyeradvantage.com. I'm making this video in May of 2016, and over the next 2 months I actually have live workshops coming up in St. John, New Brunswick, Halifax, Nova Scotia, and Boston, Massachusetts. If you want to register for one of those live workshops, which in my opinion always have much greater value than doing the online course because of the personal interaction, go to davidcbarnett.com and you'll find a live events tab that you can click on. So what do we mean by standard multiples? Here's the idea. I've made other videos about how businesses are valued, but let me do a quick recap. Basically, when we look at a business, we have to normalize the income statement to add back things that are not actual business expenses, usually personal items related to the owner. And then we take out things that are related to the management style, such as financing costs. We want to know what the actual cash flow is available from the business, and we look at one of two different forms of cash flow. The first one is SDE, or seller's discretionary earnings, and that's the total money available to an owner-operator. And SDE is our base of evaluation for a lot of very small businesses that are typically owner-run. Once you get an SDE up into the hundreds of thousands of dollars, typically over $500,000, then people will use the EBITDA cash flow base to do their evaluation. EBITDA is earnings before interest, taxes, depreciation, and amortization. The difference between those two is the fair market salary of an owner-operator. So in smaller businesses, people really are buying both a business and a job, and so they consider the cash flow of their own income as well as the profit of the business. In larger enterprises, people just assume that the management function has to be done by someone and that labor is worth a certain amount of money, so they don't include that owner-manager salary in the valuation calculation because in many instances the buyer, the investor, is not actually going to go and take that role. So think of a small mom and pop shop restaurant versus a large franchise location with 100 employees. That location could have a corporate owner in another city. So they don't want to look at the total cash flow, including an owner manager, because they're not going to have one. So back to standard multiples. Here's the idea. We take that cash flow that we know is coming in from the business and we multiply it by a certain number, and this is going to give us the value of the business. Now, this is a methodology for evaluating businesses, I prefer the specific methodology called the direct market data method, where we go and do research about that specific industry and look at other businesses that are the same size and determine what multiple people paid for that kind of business in the past. And it's a really great way to see what kind of risk other buyers have basically assigned to that type of business. So here's how it might work. And we're going to look at restaurants because there's a lot of data out there. So I might have a restaurant with an SDE, so it's a seller's discretionary earnings of $100,000. And this might be a very small operation with sales, let's say, of $375,000. So if I go into my database of past sale transactions, and only certain people with different designations and qualifications can get access to these databases, but I might do a search and look for restaurants with sales between $300,000 and $450,000, and I might find that these little restaurants sell for maybe 1.1 to 1.5 times SDE, which would mean that this little restaurant might have a value of $110,000 up to $150,000 based on the cash flow. Okay, so that's an example of looking at past transactions and getting a multiplier. Doesn't quite address the question though about standard multipliers. Let's take a look again at another similar business. Same sales, same cash flow, and this is a restaurant. Let's assume now we're talking about a septic pumping business. Okay? I might go into that same database and look at other past transactions for septic pumping businesses, and the data might tell me that those businesses sell for 3.5 times STE. Same cash flow, $100,000, but in the septic pumping industry, people might be willing to pay $350,000 for that cash flow versus $110,000 to $150,000 in the restaurant example. So why on earth is there such a huge discrepancy between the multiples in these two industries? And the answer to that question is risk. Restaurants are very numerous. Customers are price sensitive. New people can get into the restaurant business with very little investment versus the septic pumping industry where typically you have a couple of players in every rural area serving clients. People call them every couple of years, so they're not quite sure what it should cost, and if the price changes over a 3-year period, people are less likely to notice. So there's more pricing flexibility in that industry. And in order to get into that business, you might have to buy or lease a $500,000 truck, as well as get environmental permits, all that kind of stuff. So it's harder to start a septic pumping business. It's easier to raise your prices. It's less risky. There's less competition. And therefore, people are willing to pay more for the septic pumping cash flow than they will for the restaurant cash flow. Now, here's the funny thing that happens. Let's look at another restaurant. So let's say a restaurant that does $2 million in sales and has an SDE of $200,000. You might say, well, Dave, it's a restaurant. Shouldn't it be worth between 1.1 and 1.5 times SDE? And the answer is no, it's not. When we go in and look at past transactions, what we find is that as businesses get bigger, the multiples change. So in this case, again, it's a restaurant, but it's a much larger going concern. We could find that restaurants in this league go for 1.8, maybe up to 2.6 times SDE. So we end up with a business that's worth between $360,000, maybe up as high as, what's that, 520? It's still a restaurant, but buyers consider a bigger economic unit to be less risky than a smaller economic unit. Now, sometimes when you get out there in the wide world of business brokers and accountants and other people who are trying to put values on businesses, they'll try to convince you that all businesses are worth a certain multiplier of cash flow. And what I've seen in my experience is people out there saying that a business is worth between 3 and 5 times earnings. The problem is this: they don't always normalize the cash flow using the same set of rules. And sometimes people are under the impression that you multiply the earnings in order to get a value for the goodwill, which is actually not the case. Using a method like this is supposed to give you an enterprise value. Enterprise value is inclusive of all the equipment, machinery, and operating capital required to make the business function. So I've run into people who have gotten what they thought was expert advice, where they've come up with a cash flow figure that wasn't properly normalized. They multiplied it by 3, thinking that that was a standard multiple for valuing the goodwill of a business, and then they've added the operating capital and value of the fixed assets and come up with a number that made absolutely no sense. We're talking like a business with $80,000 or $90,000 in earnings being valued at $1 million. Doesn't happen in the world of small and medium-sized enterprise. So I always get very suspicious when people start talking about standard multiples when valuing a business, because what it means to me is that they're trying to use some jargon or language to give themselves credibility or authority, and they may not actually have access to the research, or they may not even know that they can do it this way. So when people are telling me that a business is worth what it's worth because of standard multiples, I would usually tend to tell people that that's a cue to go and get advice from someone else that can help you. I help people like this every day, in fact. Thanks a lot, and we'll talk with you later. If you found this information useful, please like or share the video wherever you're watching it. LinkedIn, Facebook, YouTube. It's the only way that these platforms have of knowing that the content is actually good. Thanks, and we'll see you next time.
You made it to the end of the video. That's great. Why not come over to my blog site, investlocalbook.com, where you can see all of my latest posts and videos. You can also take the time to watch my welcome video, see what I'm all about, and if you wish, sign up for my email list. I only send out one email each week. You get to choose which topics you're interested in so that you only get information that you want to learn about, and it's easy to unsubscribe anytime. Click my free resources link and have access to all of my free ebooks, audiobooks, and other PDF downloads.